Most surviving widows assume their Medicare premium stays the same after their husband dies. It does not. The SSA calculates Medicare Part B premiums using tax return income from 2 years prior, meaning the year your husband died, his income is still counted against you as a single filer. The premium can jump from $185 to over $400 every single month. There is one federal form that reverses that charge. The SSA will not send it to you. You have to know to ask for it. The envelope arrives. Not a sympathy card, not a benefits update. A bill. Stiff government paper, the kind that crinkles when you fold it, cold in the hand the way official correspondence always is. The number in the top right corner reads $258, or $363, or $443. Above the total, in small capitals, IRMAA. No definition, no explanation of how the figure was reached, no mention that a single federal form could eliminate the charge entirely, just a payment due date, while the bedroom down the hall still holds the particular quiet of someone recently gone. This happens to hundreds of thousands of surviving widows across the United States every year. Most of them pay the bill. Almost none of them know the charge is reversible. The word to understand here is IRMAA, Income-Related Monthly Adjustment Amount. Honestly, that name tells you almost nothing. What IRMAA actually is? A surcharge, an extra penalty stacked on top of your standard Medicare Part B premium because your reported income crossed a federal threshold. In 2026, the standard Part B premium sits at $185 a month. Below the threshold, that is all you owe. Cross it, and the Social Security Administration adds the penalty automatically. No advance notice, no letter. The charge simply appears. The threshold for a single filer in 2026 is $103,000 of MAGI, Modified Adjusted Gross Income, your total taxable income after certain adjustments. If your MAGI lands between $103,000 and $129,000, your Part B premium climbs to $258.10 a month. $73.10 above standard, 12 months. That is $877 a year you did not owe the year before. If your income runs between $129,001 and $161,000, the premium rises to $363.40. And between $161,001 and $193,000, $443.90. Every month, no exceptions. None of that would matter if IRMAA were calculated on what you earn today. It is not. The SSA does not look at your current income. It looks at your IRS tax return from 2 years prior. For 2026 premiums, the SSA pulls your 2024 MAGI. For 2025 premiums, your 2023 return. That 2-year gap is the mechanism that catches hundreds of thousands of widows every year. Here is what the gap looks like in practice. A woman's husband retires in 2022. They file jointly in 2023. His pension, her Social Security, combined MAGI of $160,000. A standard joint filing household. He dies in 2024. She becomes a single filer. Her own income, Social Security plus a partial pension, runs under $60,000. But the SSA does not see her current income. It sees the 2023 joint return. $160,000, $57,000 above the single filer IRMAA threshold. Her 2026 Part B premium, $443.90 a month. The SSA pulled that IRS data automatically. No warning letter arrived. The surcharge appeared with her very first Medicare bill. The belief she had carried without questioning, that her premium stays the same when her husband dies, turns out to cost her $3,106 this year alone. So the question standing in front of every widow who receives that bill is this: is there actually a way to undo it? And if so, why does the Social Security Administration never tell you it exists? So, here is what the first block established. The SSA calculates your Medicare Part B premium using your IRS tax return from 2 years prior. A widow whose joint return showed $160,000 can find herself paying $443.90 a month in 2026, while her actual current income sits under $60,000. The charge is automatic, and the SSA sends no warning. But nobody at the Social Security Administration will tell you that federal law contains an explicit exception for this situation, or that a single form filed inside a specific window eliminates the surcharge in full. Here is where the story turns harder. Think about the woman who receives that first bill in January. Her husband died the prior March. She spent the spring on probate paperwork, the summer relearning how to manage money as a single person after 31 years of joint finances, the joint account, the joint tax return, the joint everything. The fall, adjusting to a household income that dropped by more than half overnight. By the time January arrives, the bill lands $258, or $363, or $443. She calls the SSA helpline. The representative confirms the amount is correct, tells her the figure comes from her most recent tax return, tells her there is nothing to be done. The call ends. She pays. February. March. She has no reason to believe the charge is wrong, because the person she asked told her it was right. That call happens across the United States hundreds of thousands of times a year. The difference between the woman who recovers the money and the woman who does not comes down to a single piece of information the SSA is under no obligation to volunteer. The piece of information is this: Congress wrote a carve-out into federal law. Title 42 of the United States Code, Section 1395R, subsection I, paragraph 4. The life-changing event exception. Under this provision, if your income dropped because of a qualifying event, you are entitled to have your IRMAA calculated on a current year income estimate rather than the 2-year-old IRS figure. The SSA must honor that estimate. The premium must be recalculated. Qualifying events include the death of a spouse, divorce, retirement, reduction in work hours, and loss of income-producing property. A widow whose husband died in 2024 qualifies. Full stop. The instrument is Form SSA 44. Medicare Income-Related Monthly Adjustment Amount, Life-Changing Event. 4 pages, plain language. A field for your estimated current year modified adjusted gross income. A field for supporting documentation. A signature line. That form, submitted with a death certificate and proof of the prior joint filing, triggers a mandatory recalculation. If the estimated current year MAGI falls below $103,000, the 2026 single filer IRMAA threshold, the surcharge does not get reduced, it disappears. The Part B premium returns to $185 a month, back to the standard rate, as if the surcharge was never applied. The SSA does not include Form SSA 44 in any correspondence sent to bereaved spouses. It does not appear in the welcome packet new Medicare beneficiaries receive. It is not referenced in the IRMAA determination letter, the letter that states your premium amount and identifies the IRS data used to set it. The form exists. The legal right under 42 U.S.C. 1395R exists. The agency is simply not required to tell you about either. The filing window is tight. Form SSA 44 can be submitted within the calendar year the surcharge applies, or within 90 days of the date on the IRMAA determination letter, whichever gives more time. Miss both windows, and the surcharge stands for the remainder of that benefit year. Every month spent unaware of the form is a month the charge collects without recourse. The SSA carries no obligation to refund premiums from months before the form was filed. The current year income estimate does not need to be exact to the dollar. The SSA accepts a reasonable projection, a pension award letter, a Social Security benefits statement, a letter from a former employer confirming retirement date and final compensation. If the projected MAGI lands below the threshold and the actual year-end income also lands below it, the case closes in the widow's favor. If the actual income comes in above the projection, the SSA may issue a reconciliation notice the following year. The risk of projecting conservatively and landing slightly higher is measurably smaller than the cost of paying a $400 monthly surcharge for 12 months without knowing the exception existed. Which puts the next question in sharp focus. And the question is not what you would expect. It is not why the SSA fails to mail out Form SSA 44. The question is, what happens to the women who file the form correctly, submit the documentation, and still get denied? Because that happens too. And the mechanism behind it is something the SSA has never publicly explained. Form SSA 44 has 4 sections. The first asks for your Medicare beneficiary identifier, the 11-character code printed on your red, white, and blue Medicare card, which replaced the Social Security number that used to appear there. The second section asks you to identify the life-changing event. For a surviving widow, the reason code is the death of a spouse. You write the date of death. You attach a copy of the death certificate. The third section is where the actual correction happens. You write your estimated current year modified adjusted gross income. Not the joint income from 2 years ago, not your husband's pension, not the figure the SSA pulled from the IRS return. Your own projected income for this calendar year as a single filer. The fourth section is your signature and date. That is the form. 1 death certificate, 1 income estimate backed by supporting documentation. Submit it in person at any Social Security Administration field office, by mail to the address printed on your IRMAA determination letter, or by fax to the number on SSA 44 itself. Now, the reconciliation, because this is the part that makes people hesitate, and the hesitation costs them money. Look, the system corrects in both directions. If your estimated MAGI turns out lower than your actual year-end income, the SSA recalculates your premium after you file your tax return. You owe the difference between what you paid under the estimate and what the correct IRMAA tier would have required. No penalty, no interest. The SSA collects the difference by adjusting future premium deductions or reducing a Social Security payment. If your actual income comes in below the estimate, the excess premiums already collected become a credit against future Part B charges. Filing SSA 44 with a reasonable projection carries near zero downside risk. The cost of not filing is the full surcharge for every month the form sits unfiled. Here is the piece of this story that does not sit right. Think about the widow who files SSA 44 correctly, on time, death certificate attached, income estimate documented. The SSA processes the form. Her premium drops from $443 to $185 the following month. But the months before she filed, the months she spent on the helpline, paying the bill, trusting that the amount was correct because a federal representative said it was, those months are closed. The SSA collected $363 or $443 in excess premiums for every month she spent unaware of the form. She asks about a refund at the field office. The representative explains that premiums from prior months cannot be recovered once the filing window is passed. She stands at the counter, the death certificate folded the way you fold something you have handled too many times, soft at the creases, the paper worn thin where it bends, and the answer is, those months are gone. That outcome is not a bureaucratic accident. That is the designed architecture of a system that requires claimants to discover their own rights before the clock runs out. In the total dollar amount collected from widows who eventually filed SSA 44, but not in time to recover prior months, that number exists inside SSA actuarial records. It has never been published. The next layer is the one most widows never reach. If a widow's income after her husband's death drops not just below the IRMAA threshold, but well below it, to a floor the SSA does not mention in any IRMAA correspondence, the federal government offers two separate programs that go further than SSA 44 correction. The first is QMB, Qualified Medicare Beneficiary. In 2026, if your monthly income as a single filer falls at or below $1,275, QMB eliminates your Part B premium in full, not reduces it, eliminates it. The $185 monthly charge goes to zero. Medicare Parts A and B co-payments and deductibles are covered under QMB as well. The second program is SLMB, Specified Low-Income Medicare Beneficiary. The 2026 SLMB single filer range runs from $1,275 to $1,526 per month. At that income level, the program pays the standard $185 Part B premium on the beneficiary's behalf. A widow whose income falls into either range should file SSA 44 and a QMB or SLMB application at the same time. These are two separate processes with two separate agencies. SSA 44 goes to the Social Security Administration. The QMB and SLMB applications go to the State Medicaid Office, a different agency with different forms, a different address, and a different processing timeline. The SSA does not route QMB-eligible widows toward their state Medicaid office. The Medicaid office has no mechanism to flag widows who recently became single Medicare beneficiaries after a spousal death. The two systems share no automatic data connection. Most widows who qualify for QMB do not know it exists. Most of the ones who know it exists do not know that the application goes to a Medicaid office, not to the SSA at all. And the gap between the number of women who qualify for QMB and the number currently enrolled, that gap has a documented cause, a named agency responsible for it, and a paper trail that leads somewhere most people are not expecting. The biggest mistake is not filing the wrong form. The biggest mistake is waiting. Here is what waiting costs. At Tier 1, a single filer with MAGI between $103,000 and $129,000, the IRMAA surcharge runs $73.10 above the standard premium every month. 12 months of inaction, $876. Every dollar of that amount is gone the day you file SSA 44, because refunds apply only from the filing date forward. The months before are not recoverable. At Tier 2, MAGI between $129,000 and $161,000, the surcharge runs $178.40 above standard every month. 12 months, $2,144. At Tier 3, MAGI between $161,000 and $193,000, the surcharge runs $258.90 above standard. 12 months, $3,106. Not credited forward, not offset against anything. Collected and kept, because the form was not filed. When the SSA disputes an income estimate submitted on SSA 44, the process does not end at the field office counter. The Social Security Act gives beneficiaries the right to appeal. A denial of SSA 44 relief can be challenged through a formal reconsideration request, submitted in writing within 60 days of the denial letter. If reconsideration fails, a hearing before an administrative law judge is available through the SSA's Office of Hearings Operations. Updated documentation strengthens the case at every stage. A revised pension statement, a letter from a financial institution, an amended income estimate if circumstances shifted mid-year. The system is built to require persistence. The persistence is worth it. The documented reason QMB and SLMB remain under-enrolled is not a funding shortage and not a legal barrier. The Government Accountability Office has identified the same cause across multiple reports. Eligible beneficiaries are not told the programs exist, and the people most likely to reach those beneficiaries, SSA customer service representatives, are not required to mention Medicare savings programs when callers ask about high Part B premiums. The agency whose outreach gap drives the problem is CMS, the Centers for Medicare and Medicaid Services, which administers QMB and SLMB but has no mechanism to identify newly bereaved Medicare beneficiaries. A referral pathway that would close the gap, SSA flagging income-dropped widows and routing them to their state Medicaid office, exists as a written recommendation in federal reports. It has not been implemented. The paper trail leads not to a bad actor, but to a coordination gap between two agencies that share no automatic referral mechanism. That gap has a cost. It is measured in monthly premiums paid by women who qualified for $0 coverage and were never told. Now, the woman who found all of this on her own. She had no attorney, no financial advisor who caught the IRMAA issue at a review. Her husband died in October. By February, she had paid the surcharge 4 times. A friend at her church mentioned, in passing, over coffee after a Sunday service, that there might be a form for Medicare premium increases after a spouse died. The friend did not remember the form number. That was the entire tip. She went to her public library, asked the reference librarian, and the librarian found Form SSA 44 on ssa.gov inside 10 minutes. She printed it that afternoon, 4 pages, the paper still warm from the machine, gathered the death certificate and her Social Security award letter, and walked into her local SSA field office the next morning. Same-day acknowledgement. Premium corrected the following month. $876 recovered going forward. She did not get back the 4 months before she filed, but she found the form, without a professional, without a hotline, on a Tuesday afternoon at a library table, and she filed it before the window closed. That is what happens when someone passes the right information at the right moment. It is also the version of this story that most people never get. The action steps are short. Form SSA 44 is available at ssa.gov/forms. Printable, free, 4 pages. To file by phone, call 1-800-772-1213 and ask for an IRMAA life-changing event appeal by name. Walk-in filing at any local Social Security Administration field office is the fastest route. Same-day acknowledgement is standard. Bring the original death certificate or a certified copy, your Medicare card with the beneficiary identifier, your most recent Social Security award letter or pension statement, and a written estimate of your current year income. If your projected income falls in the QMB or SLMB range, below $1,526 a month, ask the representative for a referral to your state Medicaid office. They are not required to provide it. Ask for it. Subscribe and turn on notifications so the next change does not arrive without warning. And share this video with someone who needs it, a parent, a neighbor, a friend on Social Security or Medicare. They probably have not heard any of this either. Every month of delay is a month you cannot recover.